for the day. Welcome to part 7 of RBS Auditors Corporate Tax webinar series. I am Anjali, the host for this session, and today we will be discussing about transfer pricing. Before we proceed, let's take a moment to catch up on past videos on our YouTube channel. We encourage you to watch, subscribe, and support us by sharing your valuable comments and thoughts. And please don't forget to leave your feedback through a Google review using the provided QR code. We invite you to actively participate in the webinar, and in case of any doubts, please comment below so that we can address it in the Q&A session towards the end. In this session, we are going to explore a vast topic in taxes, and that is transfer pricing, including areas such as transactional profit method, FAR analysis, TP impact on intra-group services, determination of ALP for intra-group services, thin capitalization, and some practical examples. We are hopeful that your takeaway from this session will help you further in your businesses with respect to these areas. Now, I invite the speaker, Mr. Sijin K. Ravi, who will guide us through these topics. Over to you, sir.
Thank you, Anjali, for giving a brief introduction. Ladies and gentlemen, good morning, good afternoon, good evening. Thank you for joining me today for our 7th webinar series on corporate tax. In this webinar series, we are concentrating mainly on part 2 of transfer pricing. We have already discussed the part 1 in the previous webinar. If you are not visited, if you are not watched or attended any of our webinar, you can please visit our YouTube channel for more info. So we are discussing corporate tax in UAE series 7, transfer pricing part 2. So major areas covered in this relating to TP second part, it's what are the methods, then intra-group services, thin capitalization. So the agenda for today, one is we'll have a quick recap of previous webinar series, and we'll see the transactional profit method, what are the profit method, then PLI, then FAR analysis, TP impact on intra-group transactions, then ALP for intra-group, TP charging methods, thin capitalization, intra-group funding. So these are the topics covering today. So if you look at October 2023, the FTA has issued a transfer price guidance note. It's specifically mentioned about what are the methods used for that guidance notes, then what are the special transaction. All this information is already discussed. So in that guidance note, if you see specifically, they have mentioned that in case if it is not disclosed any of the points in this guidance note, please refer to OECD guidance to understand better idea of the transfer price guidelines. So this webinar we have presented based on the OECD guidelines plus whatever the guidance note issued by FTA. So we'll have a quick recap from the previous webinar. We have already discussed the traditional methods like controllable cup method, then resale price method, cost plus method. These topics we have already discussed. Then what are the cup method and RPM, CPM, it will applicable to which areas like interest or royalty, then trading operations, then sale of semi-finished goods. And now in the second series, we are mainly concentrating on transactional profit method. Is a profit split method, then transactional net margin method, then any other methods. Any other methods means other than the methods discussed in the previous one. You can select some other methods, but you have to clearly mention what type of the methods you are using. Type in the sense of what way you are projecting that methods. So we'll see one by one. So first is a transactional profit method. So what is a transactional profit method? So transactional profit method examine the profit that arises from a particular controlled transaction. That means it's basically a profit related transaction that will be compared, and that percentage will be percentage in the sense of whatever the comparison will be doing, that will be included for the calculation. For example, transactional profit method, there are two methods are there. One is a profit split method and the second one is a net margin method. So profit split method means you will be dividing the entire profit based on the sum transaction. So that means you cannot allocate differently the profit. In that case, you will be splitting the profit between two areas. And transactional net margin method means you will take one relative concept, like either based on the cost basis or based on the asset basis or based on the sales basis. Then that will be calculated. That means a percentage of net profit on sales or percentage of profit on cost or percentage of return on asset. So that basis, so basically transactional net profit means based on the transaction. So this is the method which can be easily adopted. So one of the TP methods widely adopted is the TNM method. And another thing is that internal comparable, you can easily check with the internal comparable, and external comparable you can easily get from these methods. So that's why the TNM is very popular for the transfer pricing method. And external data is easily available, then this requires less comparability. For example, if you compare with the cup method, and if you compare with the RPM and CPM method, in case of a cup method, the reliability is most important. So if it is 100% reliable, then only cup method can be applied. But in case of a transactional profit method, in that one, TNM, then you can adopt a different methods, like a relative, you can take appropriate base, either based on the sales or either based on the sales, either based on the cost or based on the assets. So that's why this method is widely used. So let's see the summary of the TNM method. So there will be a controlled transaction, there will be uncontrolled transaction. So you have to verify the controlled transaction, what is the profit percentage applicable, and what will be the uncontrolled transaction, what will be the profit applicable. Then you will be compared with third-party transaction and controlled transaction. Controlled transaction means you are doing a transaction between the related party. Uncontrolled transaction means you are doing a transaction between the third party. So first you will consider with the third party transaction, that compare the net profit margin of the tested party. Tested party means whoever may be the party, simple party. That means you can easily analyze the transaction. That type of party is called a tested party. This one we have already discussed in the first webinar series. If you look at that webinar, you will get a with example how the tested party will be analyzed. So you are comparing the tested party earned in the controlled transaction versus comparable uncontrolled transaction. So you are considering controlled transaction plus uncontrolled transaction. These two transactions you are comparing. Then you are comparing the net margin along with the related party transaction along with the third party. Then you are analyzing what will be the impact. So tested party should not own valuable. Main condition is that this method cannot be adopted for intangible property. So if any intangible property is that TNM method, we cannot adopt. And to the same net profit margin, so for one is relating to related party net profit margin, and another one is relating to third party net profit margin, and the same can be comparable. So this is what a TNM method in short. So let's see what are the profit level indicators. So we have mentioned about the relative base. So we are considering net profit with a relative base, either based on the cost or either based on the sales or either based on the asset. So what is the profit level indicators for this transaction? One is related to Berry ratio. Berry ratio means a gross profit is compared with operating expenses. For example, intermediate activity where profit is linked to operating cost. If profit is directly linked to operating cost, then you can use a Berry ratio. Second one, operating margin. That means operating profit divided by sales, where sale is the main driver. So if sale is the main part, then you take the operating profit divided by sales. If it is a return of capital employed is the main driver, in that case, for example, in case of a telecom industry, the main asset will be the large capital investment will be required. So in that case, operating profit on capital employed, that means ROI. Then operating profit on operating asset. So for example, in case of a manufacturing industry, in that construction industry and other thing, then you have to adopt based on the return on asset. Then other category, return on total cost. In that case, a profit, operating profit divided by total cost. In that case, main total cost will be the relative concept. So these are the ratios taken for consideration of TNM methods. So profit level indicators. So before analyzing the transaction, you have to see which type of industry it is involved. In that industry, which is whether it is an asset-based industry or it is based on the related to cost, it is related, or if it is a manufacturing industry, then you have to say the asset category. So let's see one example. See, for example, sales is 500,000 and the cost of sale is 350,000 and GP ratio is 150,000 and operating cost is 100,000 and net profit is 50,000. So in that case, net margin, operating margin is 10%. That means 50K divided by 500K. So this will be the range, TNM range will be applied to the corresponding transaction, then arrive the transfer price method. So transactional profit method. So there is a two method we have already discussed. One is a PSM method and the second one is the TNM method. So second method is a transactional profit method. Transactional profit method means the arm's length price will be depending on the combined transaction. For example, you cannot bifurcate between the transaction to transaction. So it's a fully interrelated transaction that cannot be analyzed on a separate basis. In that cases, you will be apply PSM method. So PSM method, how it will be applied? First, identify profit of the split from the controlled transaction of the relevant profit, and then split between associated enterprise on economic valid basis. So you have to analyze first, identify profit of the split from the controlled transaction. For the controlled transaction, how much profit is there? That profit can be split into controlled and uncontrolled transactions separately. So that basis you are splitting the transaction. So in that cases, for splitting purpose, there are two methods are used: a contribution analysis method and a residual profit split method, or residual profit analysis split method. So PSM having a two subset. One is a contribution analysis or residual profit method. So one is a transactional profit method has a two. One is a TNM and second one is PSM. And the PSM itself, there are two methods. That is contribution analysis and residual profit split method. For example, company P delivers a valuable intangible which it licensed to 100% owned company E in Europe. So company P, it's intangible, it's 100% owned in company E in Europe. Company E uses IP from the parent alongside its own IP, which has been developed to adapt the product of the local market. So second thing, in year 2023, company P has no direct cost related to the license. Asset employed by the company is a 500,000, ROE 15%, pre-royalty profits, that means undistributed combined profit is 400,000. So residual profit, that means 500,000 into 15%, that means 75,000. So 400 minus 75,000, 325 is the residual profit. So this residual profit you have to bifurcate between P and E accordingly, because you are using in this concept. It is used for intangible. So intangible, it will be automatically calculated based on the PSM method only. You cannot apply on TNM method. If you see in the previous slide, a TNM method is specifically, it's mentioned that intangible, it is not possible because it is interrelated. So P intangible is 7.5 million and company E intangible is 2.5 million. So in that case, a total residual profit is 325,000. That means 400,000 minus 75,000. Its balance is 325,000. 325,000. It has been divided into 325 into 7.5 divided by 10. That means based on the intangible asset. So this is based on the asset-based appropriation. So asset-based. So that basis, its profit is split. So this type of method is called PSM, profit split method. And each share will be 325 into 2.5 divided by 10. It will be 81,250. So the entire profit, that means total asset value is 500,000. That 15%, 400,000. In 400,000, you are removed 15%. That means it's a residual profit will be 325. That 325 bifurcated into 7.5 and 2.5 of intangible asset value. So let's see the entire strength and weakness of the five methods. CUP method, RPM, CPM, these methods were traditional methods we are already discussed in the first webinar series. If you haven't visited those things, you can just check into our YouTube channel. CUP method, it's Same product is sold in the same circumstances, then only the cup method can be adopted. So, for example, if you are looking at a green apple, then you must compare with a similar green apple. If you compare with a red apple, then that cup method you cannot compare. So, a high degree of reliability, high degree of reliability is required. So, it is very difficult to find a comparable transaction between independent enterprise. RPM method. This is a less possibility of variable not related to TP affecting comparable. That means heavily reliant on product characteristics being the same. So product characteristics must be same, then only RPM can be adopted. Weakness, difference in functional analysis will affect the reliability. So RPM, it is mainly based on the gross margin method. It will be calculated on gross margin, so there will be a reliability. So in that case, the accuracy of the accounting accuracy must be 100% accurate, then only you will get a correct picture. And cost plus method, in that case, internal cost which will be available, use data from the internal cost which will be available, again not heavily reliant on product characteristics being the same. So what are the weakness? Gross margin so reliant on accountancy consistency. So all these cases, if you see in the traditional method, it's basically RPM and CPM, it's basically based on gross margin. So gross margin, that part, if it is 100% accurate, then only this will be reliant. Next method, TNM method. TNM method usually used for net margin, and it is less affected by accounting inconsistency. And and weakness, if you see, net margin may be affected by factors do not impact on TPA. There may be a difficulty in isolating information relevant to controlled transaction. All these things we will discuss one by one example, then you will get an idea what is the difference between a gross margin adoption and what is the difference between net margin adoption. And last one, PSM or RPCM, and suitable for highly integrated activity. That means if you are using a highly integrated activity, IT related operation, in that cases, PCM we can use. And the weakness often seen too theoretical, it may be difficult to access information on foreign associates. So if you see the application method, for example, commodities or oil, then cup method we can usually adopt. Payment of interest, cup method we can use. Payment of royalty, we can use cup method. Then RPM, distribution of goods, RPM we can use. Cost plus, professional services, cost plus we can use. Contract manufacturing or manufacturing, in that case we can use cost plus. TNM, professional services, then contract manufacturing. PSM, that means multiple transaction involving intangible. So intangible related transaction, we can use PSM. And management charges, there is no specific method. Benefit test must be checked before conducting acceptable allocation. So that's why even if you see in the initial stage itself, there are 6 methods. Out of the 5 methods, then one more method, you can adopt any other method. That means you have to just see what are the benefit and the benefit test you have to do it. Then you will get that method you can adopt. We'll discuss that part in another slide. TNM, one example. A company manufactures 500 designer ski boots. A company operates in an asset-intensive industry. A comparable study applying the 5 factors have identified that the company is in the same industry with the same functional profile make a return of asset 10%. So this is basically a asset-intensive industry. That means it's you have to see that what is the percentage of return of income on asset. Original cost of the asset is USD 10 million, production 500,000 boots. And the cost of production per boot is USD 10. So calculate TP of the above transaction. So original cost of the asset is at 10 million USD. ROI, it is at 10%. We have clearly mentioned return on asset is at 10%. So ROI is at 10%. And in that ROI 10% applied, then the profit will be 1 million USD. So number of boots, it's 500 boots, and the profit per boot is 1 million divided by 500. It is a 2 per boot. And the cost of production per boot is a 10 USD. So we are already given a cost of production, it is a 10 USD. So transfer price in that case, 10 plus 2, that will be the transfer price for this product. So this is the base. So TNM, there are different relative base will be applied. One is based on the sales, one is based on the cost, one is based on the asset, one is based on the intangible. So if you see it in this area, so we have clearly mentioned the asset intensive industry. So what basis? It is an asset. Second one, company B is a distribution company. It distributes cycling accessories such as helmet, gloves, and all shoes. And accessories are all purchased from a related party. Return on sale has been identified as an appropriate PLI. So in this case, PLI is return on sale. Previous one is a return on asset. This one is a return on sale. And comparability analysis identified 3.5% as expected return on sale operating margin, 3.5% operating margin. Sale income for a company B is 800,000, operating cost is 72,000. What is the TP for the above transaction? So sale is 800,000, operating margin 3.5%. Then in that case, operating margin amount is 28,000. So total sale is 800,000. Then less cost plus operating margin. Cost is 72,000 is already cost is recorded. We already given the information cost. Then operating margin, you are adding the margin 28,000. Then reducing that figure, then you will get 700,000 as a TP. So if you see the sales income for B, so this calculation, it's just arriving at the transaction price, TP price. So let's see one more example. Company C operating in a centralized unit. It has been established that there are comparable independent companies that can offer same service at a 12.5% return of total cost. So this is another PLI method, return of total cost. So what are the total costs? Labor cost is 200,000, office cost is 110,000, operating expenses is 40,000. And total cost is 350,000. So in this scenario, what will be the TP? So total cost 350,000. That means the labor, office, and operating expenses is 350,000. Return of total cost. So ROT. That means the PLI factor it's taken is ROT. In that 12.5% is applied on that total cost. It is a total profit is coming 43,750. Then total transfer price will be 393,750 for 350,000 plus 43,750. So in this scenario, PLI we have calculated based on total cost, that percentage on total cost, 350 applied on 12.5. So now let us look at what is FAR analysis. Function analysis. So function analysis plays a critical part in establishing ALP. So if you want to see the arm's length price, you have to see the functional analysis of the each industry wise. So we will see exactly what is a functional analysis. So function, first one, comparability. This one just a recap from the previous webinar series. So we are already discussed comparability factors and comparability analysis. In that, one of the factor, 5 factors are there. One of the factor is CFCEB. CFCEB means contractual terms, functional analysis, characteristics of property or services, economic circumstances, and business strategies. These are all functional. We have already discussed. The only thing is that functional analysis we are not discussing in details. So that's why we are going that functional analysis separately. So the relationship between comparability factors and analysis is very important to understand transfer pricing. Both are not same, it's all different. So there are 5 comparability factors. In these 5 comparability factors, we are discussing functional analysis. All other 4 factors we have already discussed, including functional analysis, but we are just given a brief introduction in the first webinar series. That's why we are just coming into the functional analysis in detail. Functional analysis. So in that functional analysis, what are the one is you have to assess the comparability. What are the industry you are into the company. So for example, manufacturing industry, what are the function you are doing? Function means functional analysis, function, asset, and services, whatever the category you are doing. Then what are the selection of the TP method? What type of TP method you have to adopt? Then establishing a price, allowing for any adjustment. Once your TP method is adopted, you have to do an adjustment, whether you have to do any adjustment in order to get a correct price. Then finally, entity characterization. Finally, entity characterization, whether it is a service-related industry, whether it is a manufacturing-related industry, whether it is a full risk manufacturer, or it is a toll risk manufacturer. So on that basis, what type of function the industry is adopted, that basis we have to analyze the industry. So FA is a critical part of establishing ARP. FA is a normal starting point. A functional analysis is a normal starting point for the transfer price. So we'll see what exactly the goal functional analysis. So first is the intra-group transaction. Identify and understand intra-group transaction. That means whatever the transaction between the related party transaction you have to identify. Then second one is goal is a significant risk. To identify economically significant risk, who will manage and control? That means whether company, there are a group company, then there is a related parties. So who will manage the entire operation risk of that entity? So whether it is a group company will manage or a particular entity will manage. So depending on that one, you have to decide. Then you have to check about ensure that control transaction correctly delineated. So control transaction, you have to see whether you have properly recorded the control transaction. Then you have to adopt a tested party in order to arrive the figures of the transaction price. Tested party we have already discussed. That means a simple party. You have a one is a manufacturing unit and a second one is just a distribution unit. So if manufacturing is a complicated data, in that cases tested party will be taken based on the distribution unit, because distribution unit having a less complex party. So tested party means a very simple party. And then comparability. To form the basis for comparability, you have to see what type of comparable. Then you have to do the adjustment, determine necessary adjustment to comparable. Then you select best method, TP method you have to adopt, which whether a TNM or cup method or RPM method. Then you have to see, once your method has been adopted, then you have to see PLI, profit level indicator, whether it is an asset industry or whether it is a based on the cost we are calculating or based on the sales you are calculating. Then you have to see the PLI method. PLI, profit level indicator, then finally comparable. So once the profit level indicator has been identified, then you have to compare to ensure that a function of the risk profile of the tested party is reflected in the chosen comparable. So whether the functional analysis is very important for this purpose, it is clearly mentioned that for a TP documentation purpose, a local file, master file, disclosure file, in that case, a functional analysis, you have to do a functional analysis, then that must be documented in order to give a clear-cut picture of the transfer pricing. So you cannot simply saying that, okay, I am adopting a cup method or I am adopting TNM method. So you cannot simply put that my TP price is a TNM basis or my TP price is RPM basis. You cannot do it like that way. You have to analyze the function, then you have to document that analysis, like intra-group, a significant transaction, who is a tested party, what method you used, what adjustment you have done, then you can compare. Then function. So let's see what are the function. For example, function, it's a R&D, research and development function. For example, computer manufacturing company, then R&D will be a main key function. For example, a company has a R&D department comprised of 50 full-time employees headed by technical director who reports directly to the company A's board of directors based on country S. In that case, a separate R&D department is there, then there is a person involved, human resources involved for that R&D part, for the manufacture of computer chips. In that case, R&D is the main function of that entity. If you compare when champagne manufacturing company, R&D is very less considered with a champagne company. So you have to decide what type of industry you are occupied. Then that base you have to see whether R&D is important or it's not important. Second function, it is a procurement. And procurement means acquisition of goods and services, whether a central unit, whether a group company or a particular entity is procuring the entire goods and services for the entire group. So you have to decide whether any type of function that company is doing. In that basis, you have to analyze. And third one is the services. So if it is a services, which party is providing services? For example, in a group having a manufacturing unit and the service is carried out by another entity, so that entity will be doing the service category, but the first party, manufacturing industry, will be doing the just manufacturing operation. So in that case, manufacturing operation will be having R&D and procurement and everything, but the service industry, it will be entirely different because they are doing the service related transaction. Then manufacturing industry. Manufacturing can range from a low value, low skill function, manufacturing of a toys, for example, manufacturing of a toys or Christmas cracker, and all these things are manufacturing will be function wise, it will be very low. Compared with communication satellite, the function will be very high. So you have to decide again manufacturing, even if it is a manufacturing, whether it is the function wise, you have to see, industry wise, you have to analyze. Warehouse and logistic, which entity is doing the warehouse and logistic facility? For example, in a company having a group company having a production unit, they having a warehouse and logistic services in different countries, and these logistic services carried out by another exclusive related party. In that case, that party's function will be different with other related parties' function. So that's why warehouse and logistic. Sales and distribution, again, these are depending upon what type of sales and distribution, whether it is a highly technical is involved or less technical. For example, a stationary item, you need not to do a highly technical sales and distribution compared with a medical surgical equipment. So medical surgical equipment, you need a complete technical sales service required. But if you see the stationary products, then there is no need for that much sales and distribution services. Marketing cases, again, it is depending upon the industry wise, or whether which industry will be conducting the marketing operation, then accordingly you have to decide the related party transactions. Finally, after sales services. So after sales services, depending upon the industry, you have to see. For example, for a multinational bank, may require a substantial experience for technical support available for customers of 24 hours a day and 365 days in a year, in case of a foreign exchange trading software. So foreign exchange trading software is doing it's your product. In that case, after sales service support will be full time. You must be involved in full time. So it's again, it's based on the after sales service. Again, it's based on the function. That's why function analysis is main important category in order to analyze the TP. So if you see the food restaurant, and after sales service will be very less compared with foreign exchange trading software. For example, we'll see one example. One distributor performs a limited marketing function, and a second example, distributor perform a more marketing function. So in this case, assume that both sell the same volume of the same product on the same market at the same price. So volume is the same thing, product is the same, and the same market. And the price is, selling price is 1,000, both the cases. And the first case is a distributor perform a limited marketing function, and the second case is a more marketing function. Because of that one, first category purchases will be more, and the second category purchases is lesser, 480. And the gross profit, it's first case 440%, and the second case 520, 52%. And marketing expenses, because marketing expenses in the first itself, limited marketing function in the category case 1, so that's why the purchase itself it's more. And if you see the second category, marketing expenses, it's a 150, it's a triple time, and other expenses 300, it's the same. And the NP margin, it's a first company, it's a 5%, that means a 50, and second company is a 7%. And if you compare this one, we have already discussed the traditional method, we have already discussed transactional method. So traditional method, most of the traditional method, it is used by gross profit margin. And if you use the gross profit margin between 400 to 520, it is 120. That means 12% on sale, 12% on sale. While if you take the net margin, it's a first case, it's a 50, and second case is a 5%, and second case is a 7. That means 2% on sale. So if you see the comparability, it's in a first case, it is risk of error will be, gross margin risk of error will be 12%, but compared with the net margin, it's a risk of error is a 2%. That's why net profit margin can be less sensitive than gross profit margin. So if you see the traditional method and transactional method, why most of the methods, transactional methods are used because it's less sensitive than gross margin. So gross margin, because at TNM methods, usually it will take based on the NP ratio. NP ratio with a different PLI. And second category, so we have discussed about the function, what type of function. Then second category, asset category. What exactly asset? So there are two categories of asset: a tangible asset, intangible asset. A tangible asset means a property, inventory, cash, trade receivable. All this will be considered as a tangible asset. Intangible asset means legally protectable intangible. That means manufacturing intangible, marketing intangible, trademark. All these things coming under intangible assets. So goodwill, intangible asset. So a type of asset analyzed as a part of FA include intangible assets like a property, machinery, and both legal and economic perspective. Who owns the asset? So intangible asset, if you consider the intangible asset, who owns the asset and to whom it is given for the license to operate. So those things will be important in order to consider the asset category. So we have discussed the function category, and second category is the asset category. So for example, if you take a cash, does the company having a large amount of cash pooling system for central treasury account, or interest rate applied? So all these things you have to consider. For example, you have a group company, and a group company is central, entire cash is converted, entire cash is transferred to the group company, and the group company used as a cash pooling system, or group company is treated as a central treasury account, and from that group company it's diverted into each individual unit. And then you have to see that tangible asset, how the transaction it is happened. Trade receivable. Do the cash flow issues arises? Does the company having a large amount of trade receivable? Payment terms with RP and non-RP. So if you see in the first webinar series, we have discussed about the contractual terms. So if you see the contractual terms between the related party and non-related party, you will be having all contractual terms, including NDA, and you will be having the percentage, and within 30 days or within 60 days or within 80 days, you have to pay the collection part, and all these things will be there. But if you compare with a related party transaction, even some of the agreement itself, you won't able to see that you won't having any related party agreement. Sometimes having some transaction not having an agreement, some transaction having an agreement, some transaction not having a strict policy that within 30 days or within 60 days or within 90 days. So all these things keep into mind in order to analyze the tangible asset. Then third one is inventory. Inventory means a raw material or finished goods or whatever the category, and who is maintaining those inventory, and who is taking the risk factors are relating to that inventory. Whether, for example, your one unit is producing and another unit is taking care of the entire inventory. So that unit or that related party will be held liable for whatever the risk related to the inventory. So that you have to analyze. Then the last one is a property. So whether property is a leasehold property, whether it is a lease to connected parties, that property, whether it is given to the connected party, and what is the length of service, or who owns the property, whether that property has been owned by jointly or one of the related party, whether the property is purchased by that related party, whether it is a leased one. All this information you have to get a clear-cut picture in order to analyze the tangible asset. So now look at the intangible asset. Intangible asset, one is a manufacturing intangible will be there, legally protectable intangible will be there, marketing intangibles will be there. Legally protectable intangible like a trade name, trademark, patent, and copyright. Manufacturing intangible are important factor in company success. For example, computer chip and computer chip. Marketing intangible as per OECD TP include trademark, trade name, customer relationship, and proprietary market. All these things are considered as intangible asset. So intangible asset main category, who is on the intangible, and how that IP or IP will be allocated to the respective related party. So you have to see the related party transaction between the intangible and what will be the royalty payment to the head office, then whether that intangible is really analyzed properly. So what will be the transfer price relating to that transaction? So intangible specific transaction, they used to in OECD guidelines, there is a specific DEMBE of intangible. We'll discuss what exactly DEMBE of intangible. So intangible is defined as being an asset that is not physical or financial and is capable of being owned or controlled for use of a commercially. So it's a commercial intangible. So example like a goodwill, patent, know-how, and trade secrets, trademark, trade names, and brands, rights, under contracts, government license and other similar rights. All these categories are treated as intangible assets. And OECD has rejected group synergy and market-specific characteristics as OECD has not considered as intangibles. So intangible are easy to transfer. It should be a case that a transfer would result in a payment, however, doesn't need to be capable of being transferred in isolation. That means intangible. So whatever the intangible you are transferred. So even if it is a transferred with a free of cost, or then again you have to find out what will be the transaction price relating to this one. Development of intangible can be via contract, R&D company, or CCA. CCA means cost contribution arrangement. We will discuss CCA in detail in another slide. Once developed intangible can be sold or licensed. All these things you have to analyze. So intangible, in determining the ownership of intangible, who own the intangible? So intangible, it's OECD, it's specifically mentioned that development, enhancement, maintenance, protection, and exploitation of intangible. That is called a DEMBE. So DEMBE, who is owned? So if it is a group company is owned by DEMBE, then that person will be the owner of that intangible. So TP method most likely to be used for transaction involving intangibles are cup and transactional profit split method. So these are the profit split method will be adopted. And the valuation of intangible is very difficult, and it can be via income-based approach and market-based approach and cost-based approach. And the OECD discounted cash flow, but recognized only as good as quality of the information is used. So basically intangible, you have to see that usually it will be based on the PSM method. So you have to, again, you have to see that what is exactly the PSM part. And in case of a hard to value intangible, HTVI, hard to value intangibles, which are there are no comparable at the time of their intra-group transfer, there is a high degree of uncertainty on the future value. So we'll see what exactly HTVI. For example, company P is a resident of a country A, conducts a retailing business operating as several department stores in country A. So company P, it is a resident of a country A and a retail department. Over the years, the company P has developed a special know-how and a unique marketing concept for operation of its department store. Company P established a new subsidiary company yes in a country B. Company yes opened and operates a new department store in country B. So country A, it is main company, and subsidiary company is company yes in a country B. A detailed FAR analysis reveals that a company yes uses the same know-how and unique marketing concept as ones used by company P. So same technical know-how is used by company P. Under comparable circumstances, independent parties would have concluded that license agreement granting company yes the right to use marketing know-how in a country B. That means company P has given a licensing agreement to company yes. That means they have to give a licensing agreement because company yes is using same marketing technique, whatever the know-how of the unique know-how of the marketing technique is used in a country B by company yes. So what will be TP adjustment? So TP adjustment will be royalty for use of intangible. Transfer pricing adjustment, inputting a royalty payment from company yes to the company P for use of these intangibles. So even if there is no royalty is provided, then in that case, again, you have to find out what will be the royalty price for that transaction. Next one is relating to its risk. What are the risk include? Market risk, regulatory risk, then contractual risk, procurement risk, inventory risk, new product development risk, employment risk, credit risk, FX risk. Market risk, overall market trading condition, regulatory risk, industry subject to compliance, like for example, banking business, insurance business, that way. Contractual risk, additional cost involved for warranties, contractual risk, procurement risk, where the enterprise is responsible for securing its source of goods, inventory risk, then employment risk. Employment risk is relating to the highly skilled employees and key man manager person, in that case employment risk, then credit risk, then FX risk, foreign exchange risk. So that FAR is these are the category: function, asset, and risk. And now we will see the entity categorization. That means you have first you analyze the FAR category function level, then next you have to analyze the entity level characterization. Entity means what type of entity you are occupied, whether it is a limited risk entity, full risk entity, entrepreneurial or principal entity. So based on that basis, FAR basis, you have to identify. So especially in case of a IP, you have to see that direct correlation between the risk and corresponding entity. So if it is a greater fluctuation in the profitability, including possibility of financial loss, then the risk will be different. So if it is a limited risk entity, the function will be very less and profitability will be less. And compared with the entrepreneur or principal in that high full risk entity, then the profitability will be different. So functional profile, it's a full risk manufacturer. The second category of entity will be full risk manufacturer. Second one is a licensed manufacturer, then a contractual manufacturer, then toll manufacturer. So full risk manufacturer, where functional analysis shows that manufacturer assumes significant level of function risk in respect of process similar greater than the licensed manufacturer, then it should be considered full risk manufacturer. That means the full risk manufacturer assumes the entire risk relating to the manufacturing of the units. So in that case, full risk manufacturer, the TP adoption will be higher profit. And if you see the licensed manufacturer, it will be, again, it's a limited. So it will be based on the return on sales or TNM method. If you see the contract manufacturer, then it will be, you will be allocated a particular contract. It is, but the manufacturing, entire manufacturing, it's done in a group level, full risk manufacturer, but you will have a contract for doing specific areas. In that case, that cost plus or gross margin method. That means your the entire operation, how to manufacture and everything will be given by the full risk manufacturer according to the specification of the full risk manufacturer. Then the contract manufacturer is manufacturing that product and labeling everything. It is based on the group company's product. In that case, it is called as a contract manufacturer. So in that case, the pricing method, it is adopted cost plus method or gross margin method. Toll manufacturer, then again, it is a cost plus method. Toll manufacturer having a limited use of the risk factors. So that's why their profitability is less, and function wise, it is very less. So low risk entity is a toll manufacturer. Complex entity retain the title of both raw materials and goods throughout the process. And a complex entity bears all inventory and sales risk. So inventory related risk, then sales related risk, it will be in between. But a toll manufacturer, they will not take care of any of these risks. So it will be the overall TP method will be cost plus method. Whatever the cost incurred, that plus profit percentage. Then we will see the sales function. In that sales function, there are 5 category: full risk distributor, full distributor. In that case, cost plus method, sales support entity, cost plus method will be used. Sales support service. That means the support service you are doing only after sales service. In that case, cost plus method is used. If in case of a sales agent or commission agent, in that case, a resale price method is used. Then a limited risk distributor and a licensed distributor. In that case, the second category, this is a licensed distributor, limited risk distributor. In that case, a TNM method is used. And finally, full risk distributor, in that a higher profit. Full risk distributor, automatically higher profit will be involved. The full risk sales entity or licensed distributor taking stock risk. So mainly it's whatever we have discussed in the previous slide, same way the risk, whatever the risk associated with this distributor, full risk distributor always take a full risk relating to that stock. That's why it's a full risk distributor. But if you compare with the sales support services, they will not take any risk relating to the storing of the inventory or storing of the asset, whatever its category. So in that case, the sales support, in that case, a TP method will be adopted. It's a cost plus method. Analysis, just example, here we have a functional analysis of H group. HO Limited is a parent company. MO Limited is a manufacturer company, and DO Limited is a distributor. And here we can see H group is a group devolved activities that the parent companies just carried out the carried out head office activities. So if you see the into marker here, strategic management, and after that one, back office support, then there is a IT support system, then regulatory support. All these things, the head office is a parent company, HO is only doing that one. But if you see the MO Limited manufacturer, if you see R&D, it is HO Limited, then R&D performance, it's HO Limited, procurement, production, logistic, all these it's carried out by HO Limited. So all manufacturing function, asset, and risk are within MO. So if you see the category function, asset, risk, the function wise, whatever the R&D, then asset wise, whatever the raw material, then risk wise, warranty related transaction, and everything it's carried out by MO. So in that case, far related to distribution are in DO. And if you see the DO Limited distribution, so you have to see that the function relating to each entity wise, then you have to analyze which entity is doing that function. Then you have to select that. Let's see one more example. It's here the functional analysis of C group. In that consisting of CP Limited is a parent company, CM Limited is a manufacturing company, and CD Limited is a distributor. Here we can see group. C group is a group with a centralized activity. That means the centralized activity, the main, the transaction, it is carried out by CP Limited, and CP Limited is diverted the rest of the operation to CM Limited and CD Limited. So the function wise, it is allotted. So that's why the functional industry wise is functional things we have to specifically analyze. Now we will see, we have analyzed the function, we have analyzed the entity wise, then we will see intra-group transaction. What are the intra-group specific transactions? The OECD TP guidelines highlight several scenarios when an activity may not be a service to the group company because there is no benefit. See, you are conducting some group activity service to the another group entity, but that services it's not benefiting to any other company. In that case, you cannot include that inter-group services into TP purpose. So what are the activities considered for not considered for TP purpose? One is a shareholder activity, and the second one is incidental activity, duplicate activities. So this can be tested. So whether any benefit is available into this type of activity, how you will test it? You will test with the uncontrolled transaction with the other party, third party. So in that third party transaction, if answer willing to pay for this activity, if you are conducting with the third party, whether that third party is willing to pay for that activity. If no, then you cannot consider it as ALP for that type of transaction. That means a shareholder activity. And OECD has specifically says that if payment has been done, and if you have created a service agreement and you are given the based on the service agreement, you have paid the amount to the related party, still if the benefit is not availed to that entity, you cannot create this as a transfer price relating to those activities. So we will discuss one by one, what exactly shareholders activity, what exactly duplicative activity, what exactly incidental activities. So shareholder activities, like for example, you are conducting a meeting, shareholder meeting, issuing of shares, the cost of supervisory board, In that cases, shareholder activity not treated as a TP for TP purpose. Then cost relating to reporting requirement of the parent company. For a reporting purpose, you are giving a reporting requirement. So all subsidiary is giving a reporting to the parent company. So that type of activity you cannot consider as a consider as a shareholder activity. You cannot consider as a ALP for those activity. Third one is the raising of the fund, the cost of raising of the fund to acquire subsidiaries. Then cost relating to compliance of the parent company with the relevant tax laws. Then costs which are ancillary to corporate governance of the MNE as a whole. Cost activity relating to juridical structure of the parent company itself. So all these costs are related as a shareholder activity. So we should not charge ALP for this category. So how we'll analyze the shareholder activity, we should carefully analyze whether they create any benefit to this one. We'll see example with what exactly shareholder activity. So company E is a listed Spanish company. Company is in Spain. Head office is Spain and carries out a number of services for the benefit of itself and its subsidiary. TP analysis carried out and the following services are identified. What is the TP impact for each transaction? So first category, accounting, including management accounts, local statutory accounts of both companies, and consolidation of financial statement, that is consolidation of Argentinian results into the published accounts of company E. So subsidiary company is located in Argentina. So what will be the TP impact? Accounting service to company F, accounting services to company F are generally a nature of create benefit of the company F, and so it should be chargeable. But however, preparing a published accounts of the parent company is an activity that is solely for the benefit of the company E, should not be chargeable. That means company F is preparing for a consolidation purpose. Company F is preparing for the financial statement in order to consolidate along with the company E. In that case, that should not be chargeable, because that entire benefit, it is for the company E only, for the entire group. So you cannot identify this category. Another one, head of sales in Argentina reports to the head of sales in Spain, who monitors the performance of the Argentinian sales team. So the group head sale is carrying out a managerial control activity, which in a part are intended to ensure that Argentinian sales operation is effectively managed. That means if that sales head is not there, then they have to appoint another skilled salesperson. So in that case, then you can clearly identify that benefit should be arrived, because otherwise you have to appoint another senior person. So that activity, it is not treated as a shareholder activity, it is a chargeable activity. Another one, group CEO split his time between two companies and charge is made for his time spent regarding Argentina. Details interview shows that a group CEO split his time primarily on the basis of 1 week per month spent visiting Argentina to manage and coach local senior managers and review performance and meet key local clients. So in this case, so group CEO is visiting, specifically mentioned about the timing of the each entity wise. So this is not a shareholder activity, it is chargeable. However, during this visit, for example, that first part, it is not a shareholder activity because it is a purely a chargeable activity. In second case, for example, during this visit, Group CEO often meet Argentinian company, which is a 25% shareholder of company E, to report them as a shareholder. This shareholder activity not chargeable. So for some example, that Group CEO is discussing with the shareholder meeting in a company company E, that type of activity will not be treated as will not be chargeable as a transfer price. That means it's a shareholder activity. Second category, duplicative activity. So OECD has been specifically given any intra-group service arising from activity undertaken by a line group member for another group member, that merely a duplicate activity. So that means you are conducting some duplicating of the another activity. So that type of activity, it is not treated as a transfer price. So for example, temporary duplicate activities, mere labeling of activities, group time is group time. So if the same activity is bifurcated into different entity, then a group time is simply wasted. Then this practice is very rare, but we'll see with the example what exactly duplicate activity. For example, Company J. Company J is a law firm which has recently been acquired by a Company K, a large multinational law firm with its head office in France. Company J has a knowledge management system. So Company J has a knowledge management system, and the head office it is acquired by group Company K. Company K has its own knowledge management system. So first category, before acquisition, Company J has a knowledge management system, but the holding company, Company K, it is acquired by Company J. In that case, Company K having a knowledge management system which operate using a different incompatible software. So there is a condition that incompatible software, that knowledge management system. All group entities must use group knowledge system in order to maximize sharing of knowledge. So one condition, once it is within the group, the all group entities must use their knowledge management system. So in that case, Company J, an HOD considers, head of the department of the Company J, considers that the group system is inferior and therefore decide to continue operating existing system. So Company J is a decide that they will operate with the existing system, but setting up an arrangement where content of the local system is automatically added to the group system. That means they are using the existing system of Company J, but an arrangement with that content will be head office content, whatever relating to knowledge management system of the K will be automatically incorporated into that system. So it is like adding some services to the subsidiary. A charge is made to the Company J for its share of the group system under TP. So what happened? It's after this one, Company K put a charge to the Company J for the whatever the knowledge management system used by Company J. So what will be TP in this scenario? So there is no TP impact because it is a duplicate activity. Company J does use the group system, but it because it is if you see the previous one which operates using different incompatible software, because of these issues then they have used their own software, but they have adopted group companies whatever the related knowledge management system into their existing system. So in that case, it is a duplicate almost all capabilities offered by its own system. So use of a group system is not a service for TP purpose. This would be a duplicate service. So I think you will get an idea why this is a duplicate services come into the picture. Now let's see incidental benefit. Intra-group service performed by a group member related only to some of the other group member, but incidentally provide benefit to other members. So some group company is providing some services to another group company, but because of providing some services to another group company, that benefit is enjoyed by other group members also. Whether that type of, if the benefit is enjoyed by other group members, in that cases, then you cannot treat, you can treat it as an incidental benefit, and you cannot consider TP for this category. So intra-group services to specific members. So you are conducting some services to specific members, and economic benefit for other members because of doing some services to the specific members. That benefit is enjoyed by other members, but you are not giving directly to other members. But because of that commercial benefit, there is no intra-group services to other group members. That means incidental benefit. That type of incidental benefit is not treated as a arm's length price for TP purpose. These are the things referred by OECD TP guidelines, and the same thing, same information it is already given in UAE TP guidance notes. On-call services. On-call services means whenever the subsidiary required some of the services, then that type of on-call services. In that cases, how it will be analyzed. So you have to see that benefit benefit of that services, then only you can find out the transaction price. So you have to see that if on-call services, if you are giving to the third party, in that case, whether we can bill it to that third party. If billed to third party and third party is ready to pay for that on-call services, then you can do it. So OECD specifically suggests that performance of the party to the transaction is more important over the number of years, then you can decide this one. So now we have discussed about the function, then asset category, entity wise, then we'll see the different transaction wise, shareholder transaction, then incidental benefit, then other part. Now we'll look at determination of ALC. So one is having determined that service has been rendered, that a charge should be made. So you have done the service, intra-group service has been rendered. Then you have to put a charge for that one. Then next step, you have to determine what type of arm's length price will be considered for intra-group transaction. So TP considers intra-group services were rendered, then necessary to determine arm's length price. So one is relating to direct versus indirect, direct charging method versus indirect charging method, then cost allocation, what type of cost you have to allocate, then TP method, what type of TP method you have to adopt, a cup method or versus cost plus method, then what type of markup you have to adopt. See, once you have analyzed the cost, then how much percentage of profit you have to add it in order to arrive at the transfer price. That's called markup. So what type of markup markup you have to add in order to get the transfer price. So what are the charging method? One is a direct method. That means a direct charge arises when the associated enterprise charge providing that service. For example, clearly defined basis. For example, timesheet billing. You are given a skilled laborers, then non-skilled laborers. Then based on the human resources, you can divide. So that means a clearly defined one. Then you can adopt a direct method. Indirect method. In that cases, various associated enterprise using based on the allocation case. So indirect method based on the allocation, whether it is a cost basis or whether it is based on the investment basis, that basis you can adopt. Allocation basis, if indirect method is used, it should be sensitive to commercial features, follow sound accounting principle. That means the accounting principle should be proper, then only the allocation will be followed. That means a revenue based on the revenue based allocation or based on the headcount basis allocation. If it is an IT related thing, then based on the number of laptop or number of PC used, those things. Then TP method, cup method, cost plus method, and markups. For example, company L, a parent company of MNC, it carries out HR and IT services to a centralized basis for the entire group. So HR based on the head count of the time spent by HR team in each country. IT services based on the around every employee around the world has a desktop computer and IT department. That means HR related services is provided based on the head count or relating to PC. So IT related means relating to PC. So in that case, the allocation, it is based on either headcount or it's based on PC. That's why allocation basis. So MNC company will be based on the L will be whatever the services provided by the intra-group transaction, it will be allocated either based on HR related or based on IT related. So that's allocation basis. TP method, intra-group transaction. What are the TP method? We have already discussed the cup method and cost plus method. So cup method, if you are adopting for the intra-group transaction, then service is provided to an independent third party. If you are given an independent third party and third party is definitely they're paying for that services, then cup method can be adopted. And cup method, it is very difficult to analyze because in relation to main line of service, it will be very difficult because you will not get a comparable. And independent enterprise are not likely to disclose if you are doing, for example, if you want to compare with the cup method, what will be the prices, then independent enterprise are not likely to disclose the nature and main characteristics of the services. That means it's very difficult to get the pricing of those products. then the cup method. So the high degree of reliability is required in order to get the cup method. So if you can analyze with the uncontrolled transaction what will be the price, and if you can analyze with the controlled transaction what will be the price, then you can adopt a cup method. If it is not possible, then you can go back to the cost plus method. When cost plus used means a service provider has a little or no risk. That means risk factor will be very less. If no reliable cup is available, cost plus is generally the only other method that can be used. That means intra-group transaction cup method, if it is not available, then automatically cost plus method will be taken. A key point, cup method would produce a charge for the service, still necessary to split the cost using appropriate allocation. So even if a cup method, you are using that exactly that services, but still allocation of the respective area is still required, even if you are using for a cup method. So we will see the markup. So we have mentioned that a corresponding markup will be added to that transaction. So transactions, so what are the arm's length markup determined by a benchmarking analysis? So you will see the transaction, what type of transaction is entered between the related party. Markup made on comparable uncontrolled transaction. Uncontrolled transaction means third-party transaction. Then highly skilled employees, highly paid employees normally associated with a high risk, but you cannot assume that the profit will be the same. Profitability of independent companies. Often transaction cannot be identified in practice, necessary to resort to using the profitability of independent company that provide comparable service. That means you can see from the outside what will be the profitability of independent company. Profitability concern, if type of employees, for example, highly skilled employees are working, in that one a high markup will be. So the type of employees may be indication that service is of a high cost in nature, but not necessarily that high profits will follow. So we'll see one example relating to that one. Company N, it's a holding company. It's a prints and a distributor fashion magazine. And SP, company SP, it has a subsidiary of a company SP, which carries out a service of sourcing and procuring our small products and gift that can be given as a free gift to customers. Customers. So in that case, a company SP, that means a subsidiary, it's just like a sourcing and procuring a small gift along with the magazine. So the magazine is a distribution. It's based on the company, holding company's purpose, and it is entirely for the purpose of holding company, not for the specifically for the purpose of SP. That means a subsidiary company. So SP would not see any financial benefit by providing these services to the parent company at a cost. SP should be charged at market price. That means if SP, the same magazine, fashion magazine is distributed, printing and distributed by holding company N, and SP, that means a subsidiary company, they are adding some other small gift along with that magazine. So if you are adding that a small product along with that magazine, even SP not having any financial benefit. So what SP will not do it like a cost to cost billing will not do. So SP what will do, that cost plus markup will be added and they will charge it to the head office. So that's why the markup relating to this transaction. So it's a two transaction. It is entirely different, but you have to see what benefit, who is benefiting from this transaction. Then you have to adopt the transfer price and you have to adopt a markup. Cost base. So cost base, you have to see that what are the relevant costs relating to that one. Relevant cost, it's not only all relevant costs you have to consider, not just the salary of the staff performing, like other overhead costs like rent, telecommunication, human resource support, IT support, all costs you have to consider. Then that cost, comparable cost, whether that cost is comparable. Then you have to see the tested party information with tested party, what will be the percentage, then performance based on the costing. So whatever the performance, then you have to see. So basically the cost base means whatever relating to entire cost you have to consider, not only the direct cost, indirect cost relating to that units. For example, human resource services, you are doing a human resources services to the related party, but that human resource service, main recruitment recruitment services. For example, you are doing the centralized recruitment services for the all related party. So if the centralized recruitment services is spent, for example, 10 hours is spent for the company B, in that case, that 10 hours you have to allocate, not based on the entire hours spent. For example, one day fully spent, but only 10 hours spent, 10 hours spent for that related party, then you have to allocate based on that related party. So that's why it's basically it's a cost-based, means you have to specifically allocate relating to the respective cost, not only the direct cost, but related overhead cost you have to analyze. Then you will get a cost. Then that cost you have to add the markup. Another category is low value adding services. Low value adding services, it is just like a support in nature and not part of a core business business of the group, that do not create any unique, do not use or unique value intangible, and do not involve assumption, control, or creation of significant risk. For example, OECD specifically simplify the process of low value adding intra-group services. That means 5% of safe harbor markup that given for a low value adding services. So if it is a low value adding services, then you can ignore if it is less than 5%. If it is a more than 5%, then you have to consider that a 5% should not apply to any pass-through costs. So what are the low value adding services? One is OECD guidelines specifically says that these services should not be considered as a low value adding services. One is related to research and development services. Even if it's a 5%, research and development services, it's not treated as a low value adding services. Manufacturing and production, sales and marketing and distribution activity, financial transaction, extraction, exploration and processing of natural resources, insurance, reinsurance, corporate senior management, purchase, procurement relating to raw material used in production process. That means basically it's a main function. You cannot treat it as a low value adding service, even if it is a 5% of the total service. And what are the services may consider as a low value adding services? One is accounting and auditing, that we have already discussed some of the consolidation purpose. Matters relating to health and safety, matters relating to human resource, process of orders, managing accounts payable and receivable, general service of an administrative nature. All these things are just to give a guideline, but if you have to analyze on each category, see, for example, if you have mentioned accounting and auditing, that it's simply don't come into a conclusion that accounting and auditing is a low value adding service. You have to see that how much is the percentage, how much is the benefit out of this one, whether it is more than 5% of the total services provided by that company, then you can definitely charge that. Second, another method is a cost contribution arrangement. Cost contribution arrangements means share the contribution of risk between the other enterprises. That means jointly you are jointly produce some of the product. Then in that case, the entire cost has been share the contribution risk, and all other cost has been divided between all entity who are maybe involved in the contribution arrangement. Now we will see a special transaction relating to loans. So we are first category we are discussed with intra-group transaction, then loan-related transaction, special transaction, loan and other financial transaction. So determining arm's length relating to interest expenses. So there is a lender versus borrower. Loan transaction involves a lender lending money to the borrower and borrower paying interest. So one is a lender category, one is a borrower category. Interest and TP, interest is the consideration paid and therefore relevant for transfer price. And ALP test, you have to test the interest rate in order to meet the arm's length price. Therefore, in case where an intra-group loan is subject to transfer pricing rules, it is necessary to show that interest rate meets arm's length price. So, for example, group company is giving a loan to the related party. In that case, whatever the loan given and company is charged interest, then that interest must be checked with the transfer price. That means external interest, what will be the interest, then you have to check. Then you have to you must meet the ALP guidelines, ALP test. So determining ALP, there are two components for interest case. One is a base rate and the second one is a margin rate. A base rate means LIBOR borrower might default on a loan. Lender is still making money available to the borrower, and there is a minimum price for the use of the money. So that minimum price is called a base rate. And if you come to the margin rate, that means except the borrower is a risk-free, there would be normally a margin added to top of the base price. That means that they all will be added to top of the base price. That means that base price will be treated as a margin rate. That means a margin base rate plus some top of the markup, that will be treated as a margin price. So margin price, you will be consider all cost, including the staff cost, will be taken into consideration in order to get the base rate. So interest rate expenses will consider two category of rate. One is the base rate and margin rate. You have to analyze that rate. So why this intra-group loan? How you will do the TP for intra-group loan? So first intra-loan agreement. You have to see intra-group loan agreement. It's a vital one. Business plan for the borrower, whatever the business plan. Then for forecast financial statement, financial modeling, external loan agreement. Then external lenders, report to external lenders. Board papers, interview with the group treasury. So if it is a group treasury is doing the entire loan for the entire group, then you have to interview with those people to get an idea about what exactly intra-group loan provided by the group company. So this study requires a different skill set than other type of transaction, because you have to clearly understand what exact type of loans are provided to the other entities. So comparability data. So what are the data you have to compare in order to analyze the internal comparable? So first you look at the internal comparable within the group itself. Whatever the interest provided, whatever the loan provided to the related party, you have to look into the internal compare. Then rarely possible to compare other intra-group loans. Comparability factors are likely to differ because each loan having a different category, whether it is a fixed basis or variable basis. So it will be difficult, but still you can see the internal comparable. Then you have to see the commercial database, see some of the external database, what will be the interest rate provided for that loan, you can see. Then you can see the credit rating of the agency, what is the credit worthiness of that company. You can check that credit worthiness. Then you can see, then you can approach one of the bank to get a proposal. What will be, if I am approaching for a bank, what will be the proposal? What will be the rate for that loan? If it is not able to get, then credence asking a bank to make a formal loan offer. So all these are one of the areas. If you can clearly analyze and you can say that whatever the market rate and whatever your internal transfer, it will be matched with the market rate. That purpose only the comparability data. So all these things are discussed to understand that these are the things, these are the option available. See, if you come to the last stage, all this first 2-3 category, if you are not able to do the comparability, then you can go to the formal banking loan. For example, a company Y is operating in an IT hardware industry in UAE. Company Y obtained a 5-year loan of 100 million from a related party lender X. Credit rating of a company Y is BBB. And the search revealed that the interest rate charged for a comparable independent agreement is 5.5% per annum with the same or similar condition as a tested transaction. So in this case, a search was conducted to identify the condition applied in a similar third-party loan, and following the factors were taken into account. So total loan is 100 million, rating is a BBB, industry is IT, term is 5 years. So it is concluded that 5.5 per annum is a reasonable arm's length interest rate applicable to AED 100 million loan borrowed by the company Y. So because of 5.5 is an independent agreement provided for the lending part. Keeping the above example, same factors, if the rating has been changed, like for example, borrower company Y is A instead of B, that means rating of the B, and the triple A, it's in that scenario, it's outside independent agreement, it's showing that 4% per annum. Then TP in this scenario, it's a 4%. So you have to see the rating also, it's important in order to analyze the transfer price relating to the loans, intra-group loans. Next one, we'll see the thin capitalization. What exactly thin capitalization? So you have a equity, you have a debt. So there are, in order to, thin capitalization deals with a situation where borrower has an excessive debt related to its equity value. This where aggressive tax planning could arise. That means, for example, if your related party need an equity, in that case, if you provide an equity, what will be the impact? And if you provide a debt, what will be the impact? So if you are providing, let's first consider the a high level of debt capital, equity are determined on the independent company. So equity based on this one. So whatever equity is raised by the capital, so you will be retaining the profit in reserve. Then dividend will be declared at the year end. So dividend will be post-tax allocation. That means whatever the dividend you can declare only after paying the tax. If you come to the debt category, so you can raise a debt capital by borrowing money. So you have two options, either equity-based capital allocation or debt-based capital allocation. So if you raise a debt capital, borrowing money, then you have to pay the interest. Equity only paid out of profit, but the debt category interest is deductible. That means the interest is a pre-tax expense allocation. So what we'll do, thin capitalization means you are taking more debt and equity will be very thin. Equity is very thin and you are taking more debt and you are charging that interest in the P&L. So you will get an interest charge in the P&L. Automatically the profit will be reduced. Then interest is a pre-tax expense allocation. Then the tax will be paid on less amount. So that is a thin capital. So to avoid this one, OECD has given a guidance relating to thin capitalization. So there is a thin capitalization and intra-group funding. Intra-group parent company, intra-group loan, because of interest will be tax deductible. So automatically parent company will be happy to give a loan to the related party instead of giving as a equity. So debt equity ratio, most of the countries choose a fixed debt equity threshold in order to arrive this one. Then firm limit ratio, that means some countries, they put a set percentage as a firm limit ratio. Then a decline in profitability. Intra-group loan, parent company has an incentive to choose intra-group loan because of tax deductible. Decline in profitability, parent company will inject capital. So for example, you are suffers a decline in profitability and unable to pay interest. See, you are charged debt and you are charged interest on that one, but you are unable to pay the interest. In that case, you have to inject capital as an equity. And but multinational cannot reduce the tax payable by group company by having excessive debt level in that company. That means you cannot put debt to capital will be high and equity will be very thin. So that's why it's called a thin capitalization. Thin capitalization for intra-group funding. It's not relating to external related funding, but it's relating to intra-group funding. So if you see, some of the countries looks like debt equity ratio. For example, Kenya uses 3:1 is a debt equity ratio, and Ghana and Canada uses a 2:1 is a debt equity ratio. And UAE, if you see a debt equity ratio is in UAE, it is straight away adopted at 30%. Net interest expense being a threshold limited to UAE fixed like 12 million. Will not be subject to general interest deduction limitation rule. So general interest interest deduction limitation rule is 30% fixed by UAE. So country-wise country, it's a different one. So some countries it is adopted by fixed ratio, some countries adopted by percentage, some countries adopted by advance agreement, unilateral in nature, and some countries thin caps rule, transfer pricing rules. Some countries are adopted. So different methods are adopted for different countries. So UAE adopted, it's a percentage basis. So determining the arm's length debt level, How much could the borrower have borrowed on a standalone basis? Apply comparability analysis. So if you are a standalone basis, if you are applying, then what will be the comparable with that one? Industry specific ratio exists. For example, property development companies tend to have a higher debt equity ratio compared with the normal service industry. So service industry will be very lower debt equity ratio. Interaction with the interest rate. So the higher the debt level, the higher the interest rate. So you cannot say that you can increase the debt level to the high level, but still it is a moderate level is suggestible. Then another category, interest-free loan. Ordinarily, interest-free loan would not be acceptable under arm's length principle because an independent lender would not normally willing to lend at 0% interest. However, but certain limited circumstances, it may be possible to justify interest-free loan on the ground that loan is substance fulfilling and equity. So for example, for equity purpose, if you are taking an interest-free loan, but that one, it will be just treated as an equity because so usually TP, it's not allowed for interest-free loan. But you must prove that there is a business reason for it, then only you can justify that ground that loan is a substance fulfilling an equity function. Another thing is relating to guarantee fees. Guarantee fees is a part of the loan agreement. So one of the unit, one of the entities provided a guarantee, or the holding company is provided a guarantee to the another group entity. In that case, that guarantee, based on the guarantee, the interest rate will be lower. So in the absence of guarantee, you have to find out in the absence of a guarantee what will be the price. Then you have to compare the price. Then you have to see. So without a guarantee, it's a price. It is like a 9%, and with the guarantee, it's a price is a 7%. Then 2% you have to add back. That means without the guarantee, that will be the transfer price. So need to consider not only the lower interest rate achieved, but also higher credit extended to the borrower because of guarantee. So interest saving approach you have to see. So you have to see exactly what are the factors affecting the interest, what are the factors affecting the loan, what will be the interest if you are providing guarantee, if you are not providing guarantee, those things you have to keep into consideration. So you have to see that what will be price in the absence of guarantee, you have to decide. Other financial transaction, one is relating to a treasury function. So treasury function, it is saying that a M&E group is often set up a dedicated treasury department to manage the entire liquidity or liquidity related transactions of other entities. So treasury department will be there. That treasury department will be the pooling fund, and whenever the fund is required, then M&E will be given to the respective industry, respective or related party. So that will be a treasury function. So the related party transaction, in that related party transaction, whatever the method we have discussed before, same you can adopt. Another thing is a cash pooling system. It's a physical pooling or notional pooling, consolidation of cash balance from the multiple accounts into a central pool. So each day, whatever the cash is involved into that related party, it will be transferred to the central unit. Then from the central unit, it will be allocated. So central unit can be used for other investment purpose. So whenever the fund is required for the other entity, then they can give, or they can use it for the other investment purpose, then they can earn fund. So that basis, hedging, MNC group may use hedging instrument by which risk is transferred within the different entity. Centralized treasury function arrange hedge contract in the name of operating entity. So the hedge fund will be provided by this entity, group entity, but it will be allocated to another entity. So in that cases, this type of transaction you have to analyze separately. Then another thing is relating to captive insurance. A captive insurer is a function within a group whose role is to insure certain risk of the group. So the group will be taken the captive insurance, and within that group insurance, the other related party transactions are enjoying. Then that you have to analyze. Then you have to find out the transfer price. So these are the other transaction involved. So if you see the guidance note, UAE guidance note, you can see all this information is mentioned in the guidance note. And we may conclude with the third webinar series with the transfer price. So we are planning to discuss a business restructuring, permanent establishment, adjustment and advance pricing arrangement, and compliance documentation. So these are the things pending for RP related transactions. And you can go to our social media pages and you can follow us and stay up to date of our services, events, and everything. And if you go to our website, then you'll get a full information. Thank you for joining this webinar.